Welcome to Econ Saga, where we decode the financial storms shaking the world and uncover the truth behind market chaos today. We have just witnessed gold prices suffering their single most devastating daily drop since the year 1983, shocking investors worldwide. Silver has followed suit with a catastrophic collapse, marking its worst performance since 1980, leaving traders in absolute disbelief today. The sheer velocity of this sell-off has wiped out months of gains in mere hours, destroying billions in paper wealth instantly. This was not a normal market correction, but a calculated liquidation event designed to shake the very foundations of the metals market. From New York to London, the panic spread like wildfire, triggering stop-loss orders and forcing massive liquidations across every major exchange. The bears have taken total control, smashing through critical support levels that technical analysts believed would hold firm against any pressure. Mainstream media is flooded with headlines of doom, fueling the fear and prompting retail investors to sell at the absolute bottom. Trying to catch this falling knife has proven fatal for many brave traders who underestimated the ferocity of this downside move. But to understand this crash, we must look beyond the charts and identify the specific catalysts that triggered this financial avalanche. The first major catalyst arrived with a political earthquake as Donald Trump announced his nomination for the next Federal Reserve chair. Kevin Warsh has been chosen to replace Jerome Powell, sending shockwaves through Wall Street due to his well-known monetary policy stance. Unlike Powell, Warsh is viewed as a hawk, someone who prioritizes fighting inflation over supporting asset prices or employment numbers. The market immediately interpreted this nomination as a signal for a stronger U.S. dollar, which is traditionally bad for precious metals. The dollar index surged instantly, making gold and silver more expensive for foreign buyers and triggering algorithmic selling across the board. Warsh's history suggests he favors tighter money supply and higher real interest rates, the exact opposite of what gold bugs want. Investors rushed to pivot their portfolios, dumping zero-yield assets like gold to chase the potential returns of a strengthened fiat currency. This leadership change at the Fed signals a fundamental regime shift that the market was not fully priced in for. Algorithms reacted faster than humans, reading the headlines and executing massive sell orders before anyone could even sip their coffee. Rising treasury yields added fuel to the fire as the opportunity cost of holding non-yielding metals became significantly higher for institutions. It was a strategic checkmate for the dollar bulls, leaving gold and silver defenseless against the sudden shift in macroeconomic sentiment. Even veterans of the market were caught off guard by the speed at which the narrative shifted from inflation to deflation. This political alliance suggests a coordinated effort to strengthen the currency, at least in the short term, to combat inflation. But the political news was just the spark. The real explosion came from the mechanics of the market itself. Enter the CME Group, the world's leading derivatives marketplace, which holds the power to change the rules of the game instantly. In a move that devastated leveraged traders, the CME Group quietly decided to raise the margin requirements for metal contracts. Margin is the collateral traders must deposit to hold a position. When this requirement goes up, traders must find cash immediately. For gold contracts, the maintenance margin was hiked from 6% to 8%, a significant increase for highly leveraged funds. Silver was hit even harder with margin requirements surging from 11% to 15%, putting immense pressure on silver bulls. This triggered a wave of margin calls. Traders who didn't have the extra cash were forced to sell their positions immediately. It created a forced liquidation cascade. Selling triggered lower prices, which triggered more margin calls, which triggered even more selling. There is no emotion in this process. It is purely mathematical. If you don't have the funds, the system sells you out. Many retail traders and small funds were wiped out in minutes, victims of a mechanism designed to flush out excess leverage. Technical support levels that everyone was watching became meaningless as the forced selling pressure overwhelmed any potential buyers in the market. This is the danger of high leverage. It works beautifully on the way up, but it kills you instantly on the way down. Liquidity evaporated as buyers stepped aside, not wanting to stand in front of the freight train of forced regulatory selling. Institutional sharks waited patiently for the capitulation, knowing that the CME's move would force prices down to attractive levels. The heat map of the commodities sector turned a uniform red, a rare sight that indicates systemic selling rather than asset-specific news. High-frequency trading bots exacerbated the move, sensing the momentum and piling on short positions to profit from the downward spiral. The verdict was harsh and swift. The market had become too crowded with long positions, and the exchange decided to clean house. But seasoned investors know this is not a new phenomenon. We have seen this exact screenplay acted out many times before. In 1980, the Hunt brothers tried to corner the silver market, driving prices to dizzying heights before the rules were changed. Just like today, the exchanges raised margin requirements, drastically forcing the Hunts to liquidate and crashing the price of silver instantly. We saw it again in 2011. After a massive run-up, margins were hiked and gold entered a multi-year bear market. It is a recurring cycle. When the speculative froth gets too thick, the exchanges intervene to protect the integrity of the system. Now in December 2025, we are witnessing another chapter of this saga, proving that the market has a short memory. These events serve as a brutal mechanism to transfer wealth from impatient retail speculators to patient institutional accumulators who wait for blood. While you are panic selling, the smart money is quietly stepping in to acquire assets at a significant discount from the peak. We have moved rapidly from the euphoria phase directly into panic, skipping the usual gradual decline that allows investors to exit gracefully. This flush-out is necessary. It cleans the market of weak hands and resets the foundation for the next leg of the bull run. However, there is a critical distinction that you must understand: the difference between the paper market and the physical metal market. While paper prices crashed in the West, something fascinating happened at the Shanghai Gold Exchange in the East. The premiums on physical gold in Shanghai skyrocketed. This means people were willing to pay much more than the global spot price. This indicates that the demand for real hold-in-your-hand gold remains robust regardless of what the paper derivatives market indicates. The paper market is driven by leverage and speculation. The physical market is driven by actual supply and legitimate industrial demand. Many experts argue that the paper price is technically manipulated to suppress the true value of the metal and protect fiat currencies. But you cannot print gold. You cannot manipulate the physical shortage that is slowly developing in the background of this noise. This brings us to the fundamental reality of silver. The physical stockpiles have been draining consistently for the past 5 years. Silver is not just money. It is a strategic industrial metal essential for the green energy revolution and solar panel production. The electric vehicle industry consumes massive amounts of silver. And this demand is inelastic. They need the metal regardless of the price. The explosion of artificial intelligence requires advanced hardware, further straining the already tight supply of physical silver in the market. Meanwhile, mine supply is stagnant. We are in the 5th consecutive year of a structural supply deficit for silver. This deficit cannot be fixed by paper trading. Eventually, the industrial users will have to pay whatever is necessary to secure delivery. On the gold side, central banks globally, particularly in the East, are buying gold at a record pace to diversify reserves. They are actively de-dollarizing, reducing their exposure to U.S. debt and moving into the only neutral reserve asset, physical gold. This geopolitical trend is a long-term floor for gold prices. Sovereign nations do not panic sell because of margin hikes. Gold remains the ultimate hedge against chaos. The current volatility is just noise compared to the fundamental shifts in the global monetary system. Zoom out. Look at the long-term chart. Every major dip in the past 20 years has proven to be a buying opportunity. The dust will settle. The leveraged speculators will be washed out. And the fundamental value of precious metals will assert itself again. Do not confuse the price with the value. The price is set by paper traders. The value is determined by history and physics. In times like these, emotional discipline is your most valuable asset. Panic is the enemy of wealth preservation and long-term success. Remember the three pillars: the political catalyst of Warsh, the mechanical catalyst of CME margins, and the enduring physical demand. We hope this analysis has helped you navigate the storm and understand the invisible forces moving the markets today. If you found value in this report, please like and subscribe. It helps us continue to bring you the truth about the economy. Stay informed, stay resilient, and keep your eyes on the horizon. This is Econ Saga signing off. See you in the next video. Let's take a closer look at the hourly candles. Notice the massive volume spikes that occurred exactly when the margin news broke. The relative strength index is now deep in oversold territory, a condition that historically precedes a sharp technical bounce back up. Interestingly, Bitcoin also faced pressure, showing that this was a liquidity event affecting all store-of-value assets, not just metals. Refineries report they are working overtime to meet the demand for small bars and coins from retail investors buying the dip. The gold-to-silver ratio has expanded again, making silver look incredibly cheap on a historical basis compared to its yellow cousin. We hold these metals not to get rich quick, but to protect ourselves from the inevitable devaluation of all fiat currencies. The Fed's previous narratives have failed, and the market is now adjusting to a new reality of higher volatility and uncertainty. ETF outflows have been significant as paper investors flee, but this often marks a capitulation bottom in the market cycle. Like a phoenix, gold has a history of rising from the ashes of market crashes stronger than it was before. Education is your shield. Understanding market mechanics protects you from making emotional decisions that destroy your hard-earned portfolio value. The U.S. national debt continues to spiral out of control, a fundamental driver for gold that no margin hike can erase. Fiscal dominance will eventually force the Fed to monetize the debt, which is the ultimate bullish case for all hard assets. With energy costs rising, the floor price for mining gold and silver is increasing, putting a natural support under the market. Labor shortages and strikes in major mining jurisdictions like South America are further threatening the already fragile supply chain for metals. The BRICS expansion creates a massive trading bloc that is increasingly hostile to the US dollar and friendly towards gold. Rumors of a gold-backed trade settlement currency among these nations provide a long-term tailwind that short-term traders are ignoring. Geopolitical risks have not disappeared. In an unstable world, gold remains the only asset that is no one else's liability. Silver has been money for thousands of years. A temporary price drop in the futures market does not change its history. Over the last century, the dollar has lost 99% of its purchasing power, while gold has preserved wealth across generations. This is why we advocate for self-custody. If you don't hold it, you don't own it, especially when markets crash. Digital wealth can vanish in a cyber attack or a banking crisis. Physical metal is tangible, private, and permanent. The Fed knows they are walking a tightrope. They cannot raise rates too high without crashing the entire debt-based economy. We are living in the everything bubble. When it bursts, gold will likely be the last man standing as always. Investing is like farming. You must endure the storms and the droughts to eventually harvest the rewards of your patience. We are still in the early innings of a commodity supercycle. These cycles typically last for a decade or more. The global transition to green energy is unstoppable. It is a material-intensive transition that heavily relies on silver and copper. Some analysts predict that known silver reserves could be depleted within decades if current consumption rates continue to accelerate. Recycling cannot fill the gap. It is too costly and inefficient to recover the tiny amounts of silver used in electronics. Miners cannot sell below their production cost for long. This creates a hard floor for prices, limiting the downside risk. As the greats say, price is what you pay, value is what you get. Today, you're getting great value. Unlike real estate, gold is liquid and portable. You can take it with you, and it has no property taxes. The derivatives market is a quadrillion-dollar casino resting on a tiny foundation of real assets. It is inherently unstable. Gold is the light in the dark room of financial repression. It is the only money that is not someone else's debt. History is littered with paper assets that went to zero. Gold has never gone to zero in 5,000 years. Think of your precious metals portfolio as an insurance policy. You hope you don't need it, but you are glad it's there. Once you see the manipulation, you stop fearing the price drops and start seeing them as opportunities to accumulate more. The point of maximum pessimism is the point of maximum financial opportunity. We are very close to that point right now. The flow of gold from west to east is a river that cannot be reversed. The east is draining the west's vaults. London vaults are emptying, and Shanghai vaults are filling. The center of gravity for gold pricing is shifting eastward. The old guard of the LBMA is losing control to the Shanghai Gold Exchange, where physical delivery is the standard, not the exception. If enough traders stand for delivery on the COMEX, the paper scheme collapses and true price discovery will finally begin. In Exter's pyramid of value, when the system becomes unstable, capital flows down from risky derivatives into the safety of gold. The journey to fair value is not a straight line. It is a rugged path filled with traps, storms, and false summits. For the common man, silver is the most accessible path to financial sovereignty. It is the people's money. Stop checking the price every hour. Delete the apps if you have to. This is a long-term war, not a day trade. True wealth is the freedom from worry. Knowing you own assets that have no counterparty risk gives you that freedom. Even Kevin Warsh knows that the Fed is trapped. They can talk tough, but the math of the debt does not lie. Eventually, they will have to pivot. They will have to print. And when they do, the floodgates for gold will open. The M2 money supply has exploded. That liquidity is still in the system, waiting to flow into real assets. The suppression of prices acts like a dam. It holds back the water for a while, but eventually the pressure breaks the wall. Ignore the skeptics on TV. They are paid to keep you in the stock market casino. They do not have your best interests at heart. Read history. Every fiat currency eventually returns to its intrinsic value zero. Gold remains the constant standard. Gold is the tortoise in the race. It is slow, boring, and steady, but it always crosses the finish line. A word of caution: in volatile markets, scams increase. Only buy physical metal from trusted, reputable dealers with a track record. Verify what you buy. Use technology to ensure your metal is pure. Trust, but verify is the golden rule of investing. We want to hear from you. How are you handling this volatility? Share your strategies in the comments below. You are not alone. There is a global community of awakened investors who see through the illusion of the paper market. To recap, the hawk has landed, the lever has broken, but the factory is still running. The fundamentals remain strong. We expect volatility to continue in the short term, but the medium to long-term outlook for metals is more bullish than ever. As JPMorgan famously said over a century ago, gold is money. Everything else is just credit. Never forget that. The sun is setting on the era of easy money and paper illusions. A new day of hard assets is dawning. Take this knowledge, arm yourself with patience, and prepare for the opportunities that this crisis has generously provided. This is not the end of the bull market. It is a necessary pause, a deep breath before the next descent. If a recession is coming, gold typically outperforms stocks significantly. It is the ultimate defensive play for your portfolio. When the music stops, there will not be enough chairs. There is not enough physical metal to cover all the paper claims. Ensure you have your chair when the music stops. Do not be left holding a paper promise that cannot be fulfilled. Thank you for spending your valuable time with us today. We appreciate your trust and your support for independent analysis. Check out our next video where we will dive deeper into price predictions for 2026 and beyond. Our research is backed by data from major financial institutions and historical records, ensuring you get the most accurate picture. Econ Saga is dedicated to bringing you the truth, no matter how uncomfortable it may be for the mainstream narrative. So the final question is yours to answer. Will you panic and sell, or will you step up and buy the dip? Make your decision wisely. The market waits for no one. History is being written right now, and you are part of it. This has been a special report on the great metals crash. We will be back soon with more updates. Don't forget to hit that subscribe button and the bell icon so you never miss a critical market alert. Thank you for watching Econ Saga. Stay safe, stay smart, and keep stacking. Goodbye for now.